It takes us to our talk of the tape, the road ahead for stocks. Definitely gotten bumpier. The question now is, are there too many potholes to get around? Let's ask Tom Lee. He's managing partner, head of research at Fundstrat, also a CNBC contributor, and also here live at Post 9. Welcome back.
Great to see you, Scott.
What's going on here, Tom?
Well, it's been a rough week. I mean, this September first 4 days were down 4%. It's actually one of the fifth worst September since 1928, so it's pretty bad. I don't think there's actually a lot of fundamental arguments for why stocks are down this much, but I think we've pulled forward seasonality. This September to November period last year was really tough. Historically, it's tough, and I wonder if markets are going risk off early.
So you believe in the soft landing story. You said there's no fundamental reason for this. This is a debate over soft landing versus something worse. The market seems to be tilting towards something worse. You say no.
Yeah, the reason I don't think it's something worse, and we don't know, is that the jobs added was better than July. Remember, July was the hard landing fears because it was such a weak number, and in fact the number of industries adding jobs jumped to 53%. That's the best in 6 months, and the unemployment rate fell. So I think we're at a point where the Fed could engineer a soft landing, and that's why 2 weeks from now it's going to be important.
50, 25, does it matter to you?
I think it's going to be how the market interprets either number, because there can be such thing as a dovish 50 or a hawkish 50 or a panicked 50, even a hawkish 25. So I think the reality is the Fed is on a cutting cycle. That's really a good catalyst for rotation. Interest rates are going to fall, and it's going to help industries like housing, autos, credit cards come out of this recession. So I think it's good news when they start cutting.
Okay. What's happening in tech? We said that the Nasdaq's down more than 5% this week. We're having the worst week in about 18 months, and the tech sector itself is off more than 7% on the week. What's going on with that trade?
Tech, I think, revealed its hand last week because NVIDIA had a good number, but it fell. So when stocks fall on good news, it's either a crowded trade or something bad could be coming. And then, of course, they've led the downside this week. I think it is part of this pull forward the seasonality because people want to de-risk, and tech is a big holding. But I think on the margin there could also be a political aspect to this. Trump's probability of winning actually increased this week in the betting markets and in the polls, and I know investors think he'll be tough on China, which would be bad for semis. So I think part of this could be fears that a Trump gaining is bad for semis.
What if there's just too much priced into these stocks at this point? Valuations have gotten a little too rich, even if they're the greatest stocks in the world, which you've made the argument that in fact they are, that this is the place you want to be maybe more than any other. And what if that's true and the multiples still don't make sense?
I think it's possible. In NVIDIA's last 10 years of history, there have been 30% drawdowns, almost 8 times of similar magnitude. Its PE, NVIDIA's forward PE, was actually higher at the bottom of those drawdowns. Right now, NVIDIA's forward PE is in the mid-20s. So to me, this looks like a normal profit taking. Maybe it takes NVIDIA down to the 90s, but I think 2 years from now, that's really going to be a gift.
So when you look at all of these, are you a buyer on the dip? Are you urging people who read your research and listen to you here and elsewhere to do that?
We're close to that point, because let's say we thought that there would be a 7 to 10%, the risk of a 7 to 10% drawdown between now and November. We're almost down 5% now. I think next week we could be within that point of where we pulled forward that entire correction into the month of September. So I think we're close to the point where, I wouldn't be a seller here, and I think the lower range of the S&P's 5,400, 5,350, we're almost there now.
You think the move from August 5th to, let's say, September 5th was justified? Was it too much? Was it built on reality? What do you think?
It's hard to know. I know that there was panic that caused that 3-day drawdown, and the VIX spiked to 66, so we know that there was panic. But we also know there was a ton of cash on the sidelines already into August that was put to work. And I think part of this was a liquidity move, because we know the yen was highly correlated with that move, and it's kind of happening again. The yen's turned strong, and it's been putting pressure on stocks.
Make the case for our viewers that 21 times earnings make sense for the market. That's the current valuation. Everything could be great, and that could still be inflated. Maybe it's not, I don't know. Make the case that
Yeah.
it's fine.
Well, I think there's a couple things for viewers. Number one, the S&P is at 21 times, but that's because of the Mag 7. The median S&P stock is at 16 times forward, which is not demanding considering the 10-year's at 3.7. The 10-year is trading at almost a 30 PE multiple. So when you buy a bond and you think that's safe, you're paying a 30 PE, and you can buy equities that are growing earnings 10% for 16 times earnings. I think stocks are a bargain here, especially in a rate cutting cycle and with inflation falling.
So when you say stocks are a bargain here, you're talking about the 493? That they're the ones that you should be buying, even as we're asking ourselves, hey, is the economy a little slower than we think? Is the labor market weakening faster than we're willing to believe?
Yes. And I would say, number one, the 493 are attractive because the Fed is on an easing cycle. And if you look at something like small caps, the median PE in the Russell 2000 is 10 times earnings. You've got a huge margin of safety in small caps. I don't think tech is a sell here, but it probably is a source of funds if people are worried about seasonality. But do I think the Mag 7 is going to be lower by the end of this year? No, I think it's going to be higher, but it's just tough to know when the bottom is.
Well, the problem is you know, tech is, to use again the word of Rick Reeder, you know, recalibrating, but you don't feel comfortable going into these other areas over the last week because we have questions about the economy.
Yes.
That's the conundrum for investors. Do I buy the dip in tech, or is the re-rating still going to happen because the growth rates, albeit fabulous, are still a little bit slower than they were? And then can you really bank on the others if we're asking ourselves all these questions about the economy?
Scott, these are fair questions, and I know Rick is a very studious follower of markets, and he's pointed out credit spreads have been really stable and tight. That tells us that the growth fears is more of a narrative risk. You know, people who are hard landing folks have some ammunition, but I think the economy is tracking for a soft landing, and that means stocks are overreacting to what is seasonality, and so ultimately it's a buying opportunity.
Unless all of that is, so some would make the case, priced in. Like all of the good news is priced in. Soft landing's priced in, rate cuts are priced in. Maybe the market's even a little ahead of itself on the number of cuts and the totality that we're going to get. How do you respond to that?
I'd say that what you're describing is a major market top, and I know people are fearful this looks like 2007, but there's two things to keep in mind. The advanced decline line made an all-time high, which means there's basically zero probability the index has made an all-time high. And I'm almost positive the major market top has never happened with small caps trading at 10 times forward earnings.
All right. Before I open it up, you went small caps, I want to go small caps. Your big call that happened on this show, I don't remember how many months ago it was at this point, where small caps go 50% higher this year. Last time you were on, I pressed you on whether you still believe that. You didn't back down, and you said the back part of this year, which is now we're winding down, could still be robust for that trade. And you still believe that?
Yes, I believe it. Obviously, small caps have not followed, and they've actually been stuck in the mud, but earnings have been supportive. Small cap earnings grew 19% in Q2. They're set to grow almost 40% in Q3. That's fundamental acceleration. The PE is still 10.7 times forward. And let's keep in mind, last year, small caps moved 27% in less than 20 trading days. So I think that once the market's convinced of the Fed actually following through on the cuts, and they believe we're in a soft landing, and next week might give some confirmation, I think small caps do get the green light.
Okay, so let's broaden the conversation.